Good afternoon, everyone. I am C. Ankit Sharma, your income tax faculty for today's session. So I welcome all of you for today's class in which we will be discussing the provision regarding income under the head capital gain. This is our fourth session for this topic. In the earlier three sessions, we have covered the introduction part of capital gain, the indexation concepts, nature of capital asset, then transfer. Those are not regarded as transfer, and the cases in which transfer year and the chargeability year would be different. Okay. So today we will discuss the further provision regarding it, and also we are going to discuss test your knowledge questions. So I believe that you must studying very hard for your goal, that is to be a chartered accountant as soon as possible. And as I always say, that please revise, and there is a continuation process of revision should be there. So I welcome you all again. There are queries. Nitin is saying, sir, chat enable करवा दीजिए. Okay. Okay. So chat has been enabled. Please एक काम करो आप लोग जो भी आज good afternoon या कोई भी query पूछ रहे हो, kindly write your city name also with that. So I need to know कहाँ से आप लोग अपनी query पूछ रहे हो. तो जो भी एक ही बार करना बस. If you are saying good afternoon, उसके साथ अपनी सिटी का नाम लिखो, या आप गुड आफ्टरनून नहीं करते हो, क्वेरी पूछ रहे हो फर्स्ट टाइम, तो इफ पॉसिबल काइंडली राइट योर सिटी नेम आल्सो. So Pranav is saying good afternoon from Kochi. Very, very good afternoon. Tambeshwari is from Surat. Good afternoon, Tambeshwari. Hardik is in Delhi. Hello, Hardik. How are you? Then Andhra Pradesh, Indore se Nitin. Bhaskar is from Nanded. Hyderabad. Okay, from UP. Tamil Nadu, Bangalore, Bareilly, Ludhiana, Mumbai. Abhishek Mishra from New Delhi. Vismita is from Karnataka. Lahari Mojru is from Andhra Pradesh. Kasak is from Faridabad. Kazma is from Rourkela. Wow. And Dilip was from Guntur, Andhra Pradesh. I have been in Andhra Pradesh. There was a statutory audit in 2022. And I visited Andhra Pradesh. I went to Anantapur and Srikalahasti. That was the banks. I have conducted statutory audit over there. And Dehradun also is there. Prakriti is from Dehradun, nice place. Anurag is from Maharashtra. Good afternoon. Neeru is from Gujarat. Nivita from Tamil Nadu. Nagaraja is from Karnataka. Wow, that's so good to see that from all over the country you are connected. Good afternoon is Mahi from Delhi NCR. Kaveri is from Belagam. Apurv is from Delhi again. B. Sai Kiran is from Andhra Pradesh. A lot of students have been connected from Andhra Pradesh. Well done. Nayan Patil, sir, where are you from? You are asking from me. Okay. Okay, we'll tell. Manoj is from Gujarat, Gandhinagar. Shibbu is from Punjab. Beautiful place. So it's good to see that. So I believe that you must be studying very, very hard for your, of course, aim of your life. And revision must have been started at your part. Here are some queries. Let's see who is asking what. Miss Maruju is asking, good afternoon, sir. I have a query regarding destruction of capital asset. In that, shall we take FMV of similar asset that got destructed instead of money received from insurance company? No. If the asset has been destroyed and the insurance company paid us compensation in monetary form, so in that situation, we will take the monetary value of that compensation. But if that insurance company provide a similar asset instead of monetary payment, they are providing you a similar asset, then what asset we are receiving, the FMV of that asset need to be taken as sale consideration, and that would be given in the question. B.S. Sai Kiran is a retired banker. Okay, sir. Archana is from Tamil Nadu. Okay. Next is Amdeshwari is asking, in case of a liquidation of the company, money received and FMV less deemed dividend would be the cost of acquisition. So, sir, when the asset will sell, I guess, the asset and he will receive consideration, will he get index benefit if before 23rd July 2024? So whatever asset you have been received at the time of liquidation, so that would be the case in which we will decide what is the cost of acquisition. So of course, you are absolutely correct. The cost of acquisition would be the money receipt plus FMV less deemed dividend. So that would be the cost of acquisition of that asset, what we have received at the time of liquidation. And in future, if we will transfer that asset, before 23rd of July 2024, the indexation benefit could be taken, of course. But that should be a long-term capital asset. Only in that situation, you can take the benefit of that kind of indexation procedure. Next is Manoj Kumar is from Gandhinagar. Okay. Satyaram is from Jharkhand. Welcome. Nancy is from Gujarat. Welcome, all of you. So before starting the class, as always, we discuss or we share a thought for the day. So, what is the thought for the day? Let's see this, and it's very, very beautiful. Get into the habit of asking yourself. You should try this practically in your life. Does this support the life I am trying to create? Whatever you are doing, like if you are going for a party or any functions or whatever activities you are technically doing in your daily life. So if there's a major activity, like if you're planning to go for 5 or 6 days for a vacations, so you have to ask yourself this question regularly. Does this support the life I'm trying to create? If you feel that your brain is saying no, if you are going for a vacation of 5 or 6 days, and if you can avoid that, so that would definitely going to in a kind of a loss for your study time. So your brain will say, no, this is not going to support the life you want to create to becoming a chartered accountant. So whenever there is a question in your mind that you should do this thing or you should not do this thing, if that is going to affect your studies, if that is going to affect your goal of the life, if that is going to affect the aim of your life, then you should ask this question regularly to yourself. Regularly does not mean in every 5 minutes you are going to ask to yourself. You have to ask when you feel that there is something which can result to harm your study, etc. So if you'll ask this question to yourself, let me tell you, your brain and your mind and your uh, thoughts will definitely going to answer you. And if they are answering no, then please try to avoid these things because this is utmost important time because you have to give examination in, of course, May 2025. So that is really important to ask you these kind of question. I guess June 2025. Okay. So that was the thought for the day. Sheikh Tane, yes, your chat is visible. Now moving on to the provisions directly. So in the last class, we were gone through a lot of provision. Indexation we have done. Then the transfer, those are not regarded as transfer has been done. Okay, let me ask you a question before starting the class. Let's see how sincerely you are studying capital gain provision. So take example of suppose any long-term capital asset is transferred. And suppose it's transferred before 23rd of July 2024. Clear? So that means indexation is going to be applicable on it. So is it possible, suppose there is a long-term capital asset that's cost of acquisition is suppose 10 lakh rupees. So is it possible that this long-term capital asset has been transferred before 23rd July 2024 in this previous year only? We transferred it in previous year 24-25, but before this date. It has been transferred before this date. So is it possible that in case of long-term capital asset, we apply indexation provision? We apply the indexation provision, we multiply the index and we divide the index also, but the cost of acquisition remains the same. Is it possible? It should be a long-term capital asset. Remember, please understand the question first and then try to answer. It's a tricky question. So is it possible that if I'm trying to transfer any asset before 23rd of July 2024, that means in this previous year, but before this specific date, and if it is a long-term capital asset and we apply the indexation also upon it, we multiply the index, we divide the index, and after that, is it possible that the cost of acquisition and index cost of acquisition remains the same? Student already start. Again, Mr. What are you answering? I told you B. Sai Kiran Kumar. If you purchased in previous year 24-25, how it would be long-term capital asset? It would be a short-term now. So if I'm asking something, try to understand that. Is it possible or not? There could be answer that it's not possible. There could be answer, no could be also answer. No? It doesn't mean if I'm asked a question, I'm asking a question, so the answer should be yes only. The answer, one answer also that could be no. So if it is purchased in 24-25, then it's not possible. It would be a short-term capital asset. Okay. So Gurminder is saying no, Nitin is saying no, Tambeshwari is saying no. If somebody is saying yes, then you have to tell Deepak, Pagade, Srinivasa. If you are saying yes, you have to tell how. Okay. You have to write it down in chat and let me know how. Kazma is saying no, Shibbu is saying no, Aisha is saying no, Nagaraj is saying no, Jinki Mishra is saying no, 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 no. Hardik is saying yes. Yes, sir, as per the latest amendment, only land and building will get it and it will not include in the gain. No, no, that it would be applicable, no? It would be applicable for the purpose of calculation of tax. It would be applicable, and we are asking the cases in which before 23rd of July 2024. So please, whatever answer you are giving, Hardik, that is on or after 23rd of July 24. And my question is it possible before 23rd of July 2024 or not? The question is this. Think about it. Asset should be long term. Indexation must apply. Again, Shekha Tayana. When it's transferred in 2000, I have told you in this question that transfer should be in previous year 24-25. So we are not discussing the provisions of 2001 transfer. I told you not transfer in previous year 24-25 before this date. Bhumika is also saying no. इधर क्वेरी पोर्टल पे सत्यम राज इज सेइंग नॉट पॉसिबल. चलो आंसर तो है यस, इज इट पॉसिबल. अब आप पता करो कैसे कैसे होता है, सोचो. वी हैव ऑलरेडी डिस्कस दिस काइंड ऑफ प्रोविजन but not in this way because it's a tricky question. Whether he's saying yes, maybe the date of conversion is sold on previous year from previous owner. No, 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 not in case of conversion, of course. Tambeshwari, yes, because before LTC and STJC, after. My question is before 23rd of July 2024, is it possible, Tambeshwari? Your answer is also wrong. Aman is also saying no. The correct answer is yes. How it will happen? You have to tell the situation in which this could be happen. Lahori Maruju is saying yes, sir, because transfer index and assessee held index is same. In which situation it could be possible, Lahari? Nancy is saying no because it's short term. So the correct answer is of course yes. At time of transfer, there will be no capital gain, but we will still say, Hardik, why you are trying to prove your wrong answer? No, this is not the case. तो जरूरी नहीं है ना कि नहीं आता आंसर तो जैसे भी करके justify करो. No, if you are not getting the correct answer, so you should think about it. You should not giving again and again the wrong answer. Okay. Okay, somebody is saying something. Deepak is saying this is possible for market securities such as mutual fund where indexation and gains loss over the holding can become equal to no man. I am saying the cost of acquisition and the index, the cost of acquisition and the index cost of acquisition can only remain the same when these both index should be same. This is only possible when these both index should be same. As per arithmetical, you should understand now when it could be possible. Then at a time, this index and this index could be same. And these two index could be only same when the year should be same. And if the year should be same, that cannot be a long-term capital asset. So there is some possibility, of course. There is a possibility in which this could be happen. So Aman is saying long-term capital gain recorded in books when the asset is purchased. कुछ भी आंसर दे रहे हो. No, no, wrong answer. ऐसा नहीं है. Okay. Required period of holding Tambeshwari. Aisha is saying no indexation. Sir, I want to say. Okay. Let me tell you, is it possible? How? Okay. In case of asset where there is transfer not regarded as transfer, section 47, we have multiple cases of this, almost 12 cases. Section 47, where transfer are not regarded as transfer. कैसे देखो. Mr. A suppose purchase in 2004-5 a property for 10 lakh rupees. He gifted this property to Mr. B, his brother, in 2024 April. Fine, so this would not be regarded as transfer. And his brother sold this property to Mr. C on, suppose, 5th of May 2024 for rupees 50 lakh. So now, as per Act provision, not as per Manjula Jesha, as per Act, if you try to solve this question, so assessee would be Mr. B, his brother. Assessment year would be 25-26. Now, period of holding would be taken from Mr. A point of view because Manjula Jesha just impact the index of the previous owner. All other provisions are same. So the time period would be from 2004-5-2024. So asset would be long-term capital asset. I hope it's clear. Now the sale consideration would be, of course, 50 lakh. Now, when you will try to solve this question as per the Act provision, because we have to solve it by both method, as per Manjula Jesha and as per normal Act provision. So what we will take the cost is also as per A. But now the transfer index would be exactly what? 363. And the lower index would be the index in which asset held by assessee. So who is the assessee? Assessee is Mr. B. And he also held the asset in the same previous year, 24-25. So after even indexation, the index cost of acquisition will remain exactly 10 lakh. So the correct answer would be long-term capital gain. That would be 40 lakh. Understood? It was a tricky question. So almost on those provision in which section 47 applicable. So in that case, if the asset has been transferred, when there is a case of previous owner and assessee is there, in those cases, gift, will, partition of HUF, etc. In those cases where assessee change and Manjula Jesha apply, in those cases, if the asset has been transferred in the year, in the previous year, and if the assessee transferred that asset in the same previous year to someone, then it would be that there would be indexation, but the cost acquisition and the index cost of acquisition would be the same. I hope it's clear. मजा आया? अच्छा लगा? Okay. So that is a very interesting case for all of you. So now moving on to the provision. ठीक है हार्दिक? गलत आंसर कुछ सही नहीं करते रहते हम लोग. नहीं आता है. Just take a back and just wait for the correct answer. Okay. चलो भाई, तो हम पहुंच गए थे. ये सब डिस्कस हमने कर लिया. We already discussed all these things. The cost of acquisition part. We have discussed I guess, depreciable asset provision has been already discussed in the class. The reverse mortgage, the buyback of share, the liquidation, etc. Everything has been gone through. And now we are moving on to depreciation provision has been completed, in which I have told you always remember there could be either depreciation or there could be either capital gain provision applicable. They both cannot apply simultaneously. And in case of capital gain, if whole block of asset has been transferred, then there would be capital gain always short term or long term. But if all the asset of the block has not been transferred, then their capital gain will be applicable only if there is short-term capital gain. But if there is loss, then capital gain provision would not be applicable. So I hope till this part you must have revised all the provision and everything is crystal clear for all of you. I have also discussed that in case of buyback of share, in this column, you must remember that the note should be updated that for the company point of view, there is no taxability now. Okay, so you must have corrected the notes. So these depreciable provision has been discussed in the class with the illustration also. Now we are discussing the concept of slump sale. Slump sale. So there is a word inclusive in this uh, terminology that is called slump sale. So the slump sale says when there is a business, when there is any undertaking, and you do not want to continue that business in future. So if there is undertaking, there is any factory in which there is some business activity was going on, and now the owners decided that we do not want to continue this activity. So there is a concept that we can transfer that business in the form of amalgamation. That has been discussed in section 47. So that is a different part that we are going to transfer that business in case of amalgamation. There is one more possibility that no, we do not want to transfer that business as an amalgamation, but we need to transfer or sell or dispose of all the asset and liabilities. So the business is not going to be continued by any one person. Suppose there is a factory of textile factory, and now we want to discontinue that. So the option is we need to transfer all the asset and liabilities. All machines, land, building, etc. is going to be transferred, etc. So the business need to be shut down. So if this is the case, in which if there is an undertaking, if there is a business, if there is an undertaking, and that business or undertaking is going to be disposed of. So the assets has been distributed or sold separately. So the depreciable assets going to be transferred. So the depreciable asset treatment under capital gain would be same as per section of depreciable asset provisions we have discussed. If there is any non-depreciable asset in that undertaking like land, etc., the provisions of non-depreciable asset concept, what we have discussed, long-term, short-term, indexation applicable, not applicable, would be there. So separate capital gain need to be calculated if assets are going to be disposed of separately. But that's not slump sale. That would be called separate sale of individual assets, and on which we will calculate individual capital gain or loss, whether long term, whether short term, etc. But slump sale is something different. It says that if there is an undertaking, any business, and now we want to transfer all the asset of that undertaking on a single price, not separately. If we decided to transfer the whole undertaking at a single price, the individual assets value will not be decided, only all or full undertaking would be transferred at a single price. That would be called slump sale, lump sum sale. You understand the meaning of lump sum? What is the meaning of word lump sum? Lump sum means consolidated, no individual identity. So if I am having a factory, I have two options. If I'm trying to shut down that factory, if I'm not going for amalgamation, either I will transfer all the assets separately. So there would be separate capital gain or loss that we have discussed already. But if I decided no, I will transfer this full undertaking on a single value, inclusive of all asset, etc. Whether it's short term, long term, does not matter. Whether they are depreciable, non-depreciable, does not matter. If I'm trying to transfer full undertaking at a single price, now that would be called slump sale, lump sum value sale. So that has been described. The definition is over here. You can see it means the transfer of one or more undertaking, not asset, one or more undertaking. That means complete undertaking as a result of the sale for a lump sum or agreed consideration without values being assigned to the individual asset and liability. Without value being assigned to the individual asset and liability. So we are transferring full business, full undertaking on a single value, including all asset and liabilities value in that. So we are not transferring any asset or liability separately. So that would be called slump sale. In such sale, the consideration is fixed for whole undertaking and will be received by the transfer. Clear? So it's a very simple concept to understand. Like in case of residential house, it happens now that suppose I am having a residential house, I want to transfer that, I want to sell it. So I have certain asset, furniture, machines, or AC or television, etc. Everything has been furnished in this house. So either I can do this thing, I can separately sell the building, and I can sell the asset like furniture separately, machine separately, etc. Air condition separately. So that would not be the case of slum sale. That is just for making you understand. So this house does not is an undertaking, but if I ask someone that I will transfer full house furnished value in a single amount, at a single amount, at a single value, that would be called a case of slum sale kind of. So over here we are discussing the concept for technically an undertaking, a business undertaking we are discussing. So all the asset and liability, if having been transferred on a single value, that would be called slump sale. Transfer of one or more undertaking, the main steps, or you can say the main components of being a slump sale. The first component, transfer of one or more undertaking, not one or more asset. For a single consideration, that means for lump sum consideration. With no values attached to the particular asset, there should not be any separate value for any separate or individual asset. So that would be the case, that would be a case of slump sale. Now, very interesting thing, we have gone through with the definition of long-term capital asset, short-term capital asset, and before 23rd of July 24, the time duration for becoming asset to be a long-term or short-term was 12 months for certain assets, 24 months for certain asset, and 36 months for certain assets. So if those specific asset has been transferred, up to 12 months, up to 24 months, up to 36 months. Those would be the short-term capital asset. And if after 12 months, after 24 months, after 36 months, that would be long-term capital asset. On or after 23rd of July, this bifurcation has been divided into two categories, 12 months and 24 months. So technically 36 months category to becoming an asset, a long term has been abolished on or after 23rd of July 2024. Clear? But we still have an asset or a gain which would be considered as long term or short term depending upon 36-month criteria. And that is for slump sale. Now the problem arises in slump sale is this. In case of slump sale, if you are transferring an undertaking, so there would be multiple asset in this, multiple machinery, furniture, land, building, etc. Some of them must be before 12 months we are transferring, like some machinery we have just purchased 6 months back, and now we are transferring under slump sale that machine. So that machine is less than 12 months. Maybe some is more than 24 months or less than 24 months, etc. So how we will define the nature of capital gain? How we will find the nature of capital gain? Because if it is long term, the rate of tax would be different. If it is short term, the rate of tax would be different. If it is long term, before 23rd of July, we have to apply the indexation. If it is long term, on or after 23rd of July, we need to apply the indexation in case of land and building. So there would be a lot of confusion. How you will decide the time duration for each and every asset? How you will apply the cost of acquisition provision for each and every asset, how you will apply the indexation concept in those different nature of asset, etc., etc. So to overcome all these problems, The provision has said that the period of holding of that undertaking, that business, we will see the period of holding of that business. If the business is more than 36 months old, it would be long-term capital gain, or the slump sale would be treated as long-term capital gain. If the undertaking has been transferred before or up to 36 months, then this gain in asset would be treated as short-term capital gain or short-term capital asset. So technically, 36 months concept is still there. So it has been removed from the definition of long-term capital asset or short-term capital asset, but it is still under slump sale concept. So for the purpose of slump sale, again, you have to keep in your mind that we have to see whether undertaking is more than 36 months old or on or before 36 months. If a business running from last 5 years and now you transfer it as a slump sale, so that would be long-term capital asset. And if the business was running for only 30 months, 2.5 years, so still that would be called short-term capital asset, not long-term capital asset. So it's still 36 months concept is there, even on or after 23rd of July under slump sale provision. Who is transferred? Anyone can be a transferor, individual, HUF, etc., company, whatever. So if you are transferring any undertaking, whether you are any kind of assessee, individual, HUF, partnership firm, company, etc., slump sale provision would be applicable. B. Sai Kiran Kumar is asking, is slump sale for individual firm or for company? For everyone. I am running a factory as an individual. So if I have decided to transfer that undertaking at a single value under slump sale, so that would be the case of slump sale. If A Limited is running a factory and it decided to transfer that undertaking for a single lump sum consideration, that would also be a case of slump sale. Okay. Period of holding clear हो गया. Again, for the purpose of calculation of capital gain in any question, what main components we need? Okay, चलो कौन बताएगा? To solve a question of capital gain, whether it's long term or short term, what components we need? First is assessing. नहीं ऐसे नहीं आगे cost of acquisition नहीं, step by step. First of all, we have to find out who is the assessee. The second thing is period of holding. That means we need to find out whether it's long term or short term. Clear? What is the third thing we need to find it out? Sale consideration. Well done, Manvi. Sale consideration we need to find out, or expense on transfer minus करेंगे तो net sale consideration आ जाएगा. If that is in question, expense on sale भी ले लेंगे हम और उसे माइनस करके निकाल लेंगे net sale consideration. अभी पता चलेगा why net sale consideration is so necessary to find out separately. It should be separately shown in the solution. You should not try to directly deduct it and write it down directly the value as net sale consideration. Okay, fine. इसके बाद we need the cost of acquisition. ठीक है, cost of acquisition and cost of improvement. अब if indexation is applicable, then we have to index value be required. And if indexation is not applicable, then that is going to be deducted directly. Very well done. Correct. Now, under slump sale, let's see what we have and what we need to find it out. Like assessee would be that person who is the transferor. There is no previous owner concept, etc. कोई issue नहीं है, ठीक है ना? So transfer would be my assessee. Period of holding we have decided if undertaking is more than 36 months, long term. If less than 36 months, short term. So if equal to 36 months, तो क्या बोली जाएगी? Up to 36 months क्या होता है? Long term or short term? Okay, correct. You guys are not confused. Correct. It's short term. So in all cases, whether it's 12 months, 24 months, or 36 months, that is up to. So equal to or less than 36 months, it would be short term. More than 36 months would be only long term. Very well done. So we have the assessee, we have the period of holding. Now the sale consideration and expense on sale consideration would be given in question. Not to worry about this. So everything is very sorted in case of slump sale provision. Now you do not need to do the indexation. That's a good news. Whether it's before 23rd of July, after 23rd of July, no requirement of indexation because practically we cannot do that. There would be multiple assets. The individual purchase date would be different. The indexation, if you're going to applicable, then there would be depreciable asset also in this, non-depreciable also, short term also, long term also. So there would be a lot of conflict that how we need to index those values. So even the gain is long term, there would not be any indexation in case of slump sale. So there would not be any indexation. Clear? Now the problem is the cost of acquisition and cost of improvement, how we need to find. Whether we need to find it separately, like we have to do it like depreciable asset, we have to do separately, non-depreciable, we need to calculate separately, non-depreciable having short-term provision different, long-term provision different, depreciable asset would be short-term capital gain, etc. So these provisions could be different, etc. So that would be really difficult and really messy. We cannot do this. So to simplify this, a very simple provision has been made because if we able to find out the correct cost of acquisition or cost of improvement, if we able to find it out, the question will be solved because in case of slump sale only this simple thing, this is very important to solve because there is no previous owner concept, there is no short term long term issue is there because it's very easy to find it out whether undertaking is 36 months or not. Sale consideration is very easy, it would be given in question directly. The main problem is to calculate the cost of acquisition or cost of improvement. So it has been decided the net worth of that business would be treated as cost of acquisition or cost of improvement if asset is short term capital asset. And if asset is long term, then exactly this net worth would be treated as index cost of acquisition and index cost of improvement combined. So if it's short term, this value would be called cost of acquisition and cost of improvement. If it is long term, then this value would be called index cost of acquisition and index cost of improvement. No indexation would be done. This net worth will be deemed to have been considered as index cost of acquisition or index cost of improvement or cost of acquisition or cost of improvement. So to solve a question of slum sale, if we are able to find it out this value correctly, the net worth, the question will be really easy to solve. So if we know what is the definition of net worth or how to calculate net worth in a question, so that would be really easy. So I believe you all must know what is the meaning of net worth, how we need to calculate it. So very general definition is like this, that all the asset less outside liabilities. Okay, Hardik is saying asset minus liability. So that would be zero, Hardik. What kind of answer is this? Asset minus liability is zero because if your balance sheet is tallied, so asset is equivalent to liability. So if you deduct asset minus liability, that would be zero. So this kind of answer we should not expect from your kind of students. So you all are very sincere student because you are joined this class live. So definitely you know the worth of these classes and your future also. Vaidehi is almost correct. Yes, shareholders fund Vaidehi, but suppose if it is not a case of company. So if it is an individual case, then there would not be any shareholder fund, no? Because there would be proprietorship capital or partnership capital. Manvi is saying, yes, all asset minus outside liability, we can say. And we can say capital plus reserve also, of course, paid up share capital and reserve in case of company is correct. Total asset minus current liability minus long-term liability. So that would also outside liabilities correct. So this would be a very simple formula to find it out. The net worth is all asset minus outside liability. There is also some reduction like reduction of amortization expenditure, miscellaneous expenditure, fictitious asset need to be also deducted, etc. Fictitious asset. minus miscellaneous expenditure if it has been given in the balance sheet. So this is a general definition that all asset minus K outside liabilities. Clear? Now the problem in the solution is to find out the correct value of those assets, because in these assets there would be some depreciable asset also. So depreciable asset, in case of depreciable asset, we need WDV values for the purpose of calculation of net worth. For non-depreciable asset, we need book value or the purchase value or the historical value. Clear? For liabilities, there would be liabilities that would be have been given in the question. So that is not that simple to calculate, because in these kind of question of capital gain, more than capital gain calculation, there would be calculation for calculation of net worth. So if you are able to find out the correct net worth, you would be able to solve this question very easily. Understood? Let's solve a question which has been taken from your study material. A very interesting and beautiful question is there. Chalo, cost of acquisition and cost of improvement. The net worth of the undertaking or division on the date of transfer shall be the cost of acquisition and cost of improvement. No indexation would be done, of course. Meaning of net worth, we have described that total asset minus current liability minus long-term liability, that means outside liabilities. Miscellaneous expenditure, fictitious asset, etc., if any, need to be deducted. Or we can say the shareholder fund in case of companies. Report of chartered accountant need to be there. This is very important. सबसे important point यही वाला है बच्चों, स्टार लगा लो. हर काम में सीए की रिपोर्ट चाहिए. Everything, tax, audit, etc., etc., सब कुछ. Okay. So CA will tell that this calculation of net worth is correct. So we need a report from a chartered accountant. So every SSC, can you see your name in this? This is your name. Everybody. Can you see this name with your name? CA. Can you see your name in this? This is the prefix with before your name, the CA. Imagine that time when you will get this CA before your name, like CA Ankit Shan. कितना अच्छा लग रहा है. ऐसे आप लोगों के नाम क्या लगेगा अगर पढ़ोगे ढंग से तो. ओके. So every assessee in the case of slum sale shall furnish a prescribed form on or before 30th September of assessment year. So that means we are talking about up to 30th September 2025. You have to submit a report being the specified date referred under section 44AB, the date 1 month prior to the due date of filing of return under section 139(1). A report of a chartered accountant indicating the computation of net worth of the undertaking or division. So whether undertaking has calculated or computed the net worth correctly, that CA should submit a report in which he will tell that yes, net worth has been calculated correctly, as the case may be, and certifying that the net worth of the undertaking or division has been correctly arrived at in accordance with the provision of this section, that is subsection 3. So a report need to be submitted if there is a slum sale. Yes, not today, but definitely one day. Who said this? Nitin is saying, okay, yes, definitely, definitely. Okay, so now we have a question, and you will understand that when you think that is a very easy question, so it is easy. If you are able to find out the net worth correctly, definitely this is one of the easiest solution in your examination purpose. Let me tell you, when this kind of question will be in an examination, you can see this would be almost one-page question would be there. A complete balance sheet would be there, and of course the information also. But the solution would be very easy if you are able to calculate the correct net worth. So let's solve this question. First of all, read it carefully. Mr. A proprietor of Akash Enterprises having 2 units. He transferred on 1st April 2024 his unit number 1 by way of slump sale for a total consideration of 25 lakhs. So we got the sale consideration. I got the sale consideration. So one problem is solved. Unit 1 was started in the year 2005-6. So he transferring this unit in 2024-25, which was started in 2005-6. So period of holding of 36 months would be counted from 2005-6 till 2024. So it would be almost 19 years. So that is long-term capital asset. So one information, assessee, I know who is assessee. This is Mr. A's assessee. Sale consideration, I find it out that is 25 lakh rupees. The third thing, the period of holding, I have found that is third information I got. Now the remaining is just to calculate the net worth. So if I am able to find out the correct net worth, so that would be my answer. Again, the expenses incurred for the transfer were 28,000. So that is also an information for me that would be deducted from sale consideration to arrive at net sale consideration. The balance sheet as on 31st March 24 has been given. So the provision says that we have given the liabilities and the asset of both unit 1 and unit 2. Unit 1 has been transferred. So I have to take the unit 1 asset and liabilities to find out the correct net worth. And the other informations are also there. So own capital, this is combined. Liability has been given. Consolidated. Revaluation reserve for building of unit 1. Revaluation reserve for building of unit 1. So that is a very interesting thing. What we do for the purpose of revaluation reserve, there is no concept of revaluation reserve under income tax. It does not consider because that is not a true value. That does not show the true value of assets. So any kind of reserve, if it increased your asset value, that should be ignored for the purpose of net worth calculation. Okay. So revaluation reserve is connected with unit 1 building. So that would be over here. Clear? Then bank loan 70% for unit 1. So bank loan has been given 2 lakh rupees, out of which 70% belongs to unit 1. So that means 1,40,000 is for unit 1. So when we need to deduct the liabilities out of this bank loan, we will consider only 1,40,000. Trade creditors 25% for unit 1. So out of this 1,50,000, 25% is the liability, current liability for unit 1. So that would be 37,500 rupees. Clear? Till now. So we have liability of 140 and 37,500, but yet there are more information. It says revaluation reserve is created by revising upward the value of the building of unit number 1. So that means this revaluation reserve effect has been included in the building value. So we need to remove it. So that means the building real value would be 12 lakh minus 3 lakh. So for the purpose of valuation of net worth, we will take the building value, that is rupees 9 lakh. First of all, the point number 2 say no individual value of any asset is considered in the transfer deed. All other assets value are normal. Other asset of unit 1 includes patents. That means we're talking about other asset, this part. Acquired on 1st July 2022 for 50,000 rupees, on which no depreciation has been charged. So patent has been purchased on 1st July 2022 for 50,000 rupees value, which is included in 1,50,000 value. So that means this value is wrongly included in the value of other assets. So that is a wrong value because depreciation should have been charged for 2 years. One is from 20 to 23. What is the depreciation rate on patent? Who will tell? You have gone through with the provision of PGBP. So what is the depreciation rate on patent? That is exactly correct, 25%. Yes, 25% is the rate which is applicable on patent. So we have to charge depreciation for 2 years at the rate of 25%. We will get a WDV. Then again, on this WDV, we'll charge a depreciation for the previous year 23-24. Then the remaining value should be added as the value of other asset. So now they ask us to calculate the capital gain for assessment year 25-26. Let's see one by one whatever we have. We have the sale value. We have expense on sale. So that is the net sale consideration. Over here, there is no problem to sort or to find out the calculation. Now the net worth, we need to see how we calculate the net worth. So as we discussed, the building value would be taken only 9 lakh rupees because the revaluation value need to be reduced from it. Then there was a machinery of 3 lakh rupees. So because there was no other information has been given, so we will consider that this value is after charging depreciation, etc. The debtors for unit 1 has been given in the question 1 lakh. So we are considering all asset. You can see from the question, this 12 lakh, that means 9 lakh we need to take in. This 3 lakh need to be taken full. There was debtor 1 lakh rupees need to be taken full. This other asset has to be reduced by the patent and the balance would be the other asset. So because in this 1,50,000 of other asset, 50,000 belongs to patent. So technically, as I said, we will consider 1 lakh rupees. And for patent, we will charge 2 years depreciation and remaining value need to be added under asset category. So now patent value after 2 years depreciation would be 28,125 and other asset would be 1 lakh after removing the 50,000 patent value. So now my total asset would be 1428125. Now creditor value 25% was 37,500 and loan value 70% need to be reduced. So that is my net worth and that is equivalent to my cost of acquisition, cost of improvement, index cost of whatever you want to assume. We even do not need to write it down that that is cost of acquisition or cost of improvement. We just need to deduct the net worth. Because the provision says the net worth would be equivalent to your cost of acquisition and cost of improvement or index, etc. So in the solution also, we need not to write the cost of acquisition word, etc. We just need to deduct with the word of net worth. That was 1250625. So that is my long-term capital gain. I hope it's clear. If there's any confusion, you can ask me. So the important thing in slump sale is to find out net worth correctly. Please remember this net worth calculation is the main calculation in case of slump sale question. I have seen that slump sale question has been asked in the examination for 6 marks, for 8 marks, or at least for 5 marks. So because when paper was for 100 marks income tax or 70% marks for income tax, 30% GST, so the question from slump sale was like 8 marks or 10 marks. But still, if a slump sale question is going to be asked in examination, let me tell you, at least it would be for 4 or 5 marks at least. And you can see these are very easy to score. We do not need to do anything. We just need to calculate the net worth, and the calculation of net worth is also very simple. There is nothing complicated in this. Okay. B. Sai Kiran is saying, sir, even if some asset purchased 1 month before slump sale, firm started business 5 years back, it is long-term capital gain transaction. Even asset has been purchased 1 day before, even still it does not matter. The gain would be treated as long-term. Okay. Nana Patil is saying, sir, please show the calculation for depreciation. Over here, you can see that. Okay. When taken ICOA in long-term capital as no indexation required in slump sale cases. In slump sale, the net worth is equivalent to COA, ICOA, COA or COA word in the solution. Sir, if FMV of asset and sale consideration of slump sale are given, then higher of these will be sale consideration. No. The sale consideration would be taken whatever has been given in the question. Why this FMV of asset and sale consideration concept has been from where it has been come? No, there is no concept like this over here. So paper 3 is full practical. Kindly go through the previous paper and you can find it out how much practical and theoretical it is. So we are not here to discuss about the paper shake. We are just going to discuss about the capital gain provision. Neha is saying, sir, how revaluation reserve is deducted? That is 3 lakh from 12 lakh rupees because it has been given in question. Revaluation reserve cannot be the part of any asset value. You must have gone through in accounts also that that is not a real appreciation of value. So revaluation reserve has been given in this and it was been written that this is for building unit number of 1. This is including under building unit number 1. And point 1 also says that revaluation reserve has been created by revising upward the value of building. So we have to find out the correct value without revaluation. So we reduce this for 3 lakh rupees. So the remaining value of building would be 9 lakh. No, you are saying if the FMV value has been given in the question at the time of transfer. Yes, if at the time of transfer the FMV value has been given, then we can take this value. Not in this illustration. In this illustration, 25 lakh rupees has been given. So we will consider that. If the FMV value has been given on the date of sale consideration, then we can consider it, whichever is higher, as your sale consideration value. Of course, that. I was getting confused that you are talking about the purchase FME value. Fine. Next is, so that was the slum sales provisions. We have just discussed the slum sale provision. No indexation benefit in case of slum sale. It is the diagram also to make you understand that how you can calculate the slum sale provision. Is it undertaking before 36 months? Then it would be long term. If it is less than 36 months, that should be short term. You can see this has been given in question also the provision full value of consideration equivalent to fair market value of the capital goods on the date of transfer. Okay. Deemed cost of acquisition, we have to find it out the net worth. Net worth would be the asset less the current liabilities and long-term liabilities. For the value of asset, the provision says in case of depreciable asset, we have to take the WDV. In case of self-generated goodwill of a business or profession, the value would be nil. In case of capital asset, where the whole expenditure has been allowed under section 35 AD, you must have gone through with under PGVP section 35 AD specific business, like specific hotel, hospital, cold storage, warehouses, chain, etc. So if the capital asset belongs to those business, the value need to be considered as nil. In case of other asset, we need to take the book value. The next concept is computation of capital gain in case of non-resident. In case of non-resident, capital gain from the transfer of shares or debenture. Kindly read these provisions very carefully because at a time of calculation of tax, we need to understand that this part of calculation, this kind of capital gain need to be taxed with a specific separate rate. So kindly understand what is the specific point in this provisions, and we are discussing non-resident. First of all, that should be a non-resident. So if non-resident having capital gain from the transfer of shares or debenture, in an Indian company shall be computed in foreign currency initially utilized. This is very interesting. So if these shares and debentures of an Indian company has been purchased in foreign currency, there should be a non-resident first condition. The asset should be share and debentures. The third condition, it should be from an Indian company. And the fourth and utmost important condition is that it should be in foreign currency. So if any non-resident purchase shares debentures of an Indian company in foreign currency, and now in this previous year or in any previous year, he transfer them, then we have to calculate the capital gain in foreign currency in which that was initially purchased. Understood? So what conditions should be fulfilled to apply these kind of provision? Nayan Patil is saying, जो कैसी बातें पूछते हो? Nayan Patil is asking, that patent acquired on 1st July 2022. In the last question of Slump Sale is asking, sir, patent acquired on 1st July 22. So we need to depreciate asset only for 9 months or consider 12 months. So why we charge full rate of depreciation and we not charge 9 months depreciation? Nayan Patil is asking. So who will answer? Why we charged on patent full year depreciation in the case of last example? Vishmita has given the correct answer. Mr. Patil, in case of income tax, there is not 9 months or 12-month base. It is a 180 days concept. So if asset has been put to use for more than equal to 180 days, full rate of depreciation need to be charged. You must have gone through with the PGBB provision. Section 32 deals with it. So because is it less than 180 days, then we charge 50% depreciation rate. And if it is more than 180 days, then we charge full rate of depreciation. So asset has been purchased in, I guess, July. So it is more than 180 days. So we charge full rate of depreciation. Okay. Okay, तो हम क्या डिस्कस कर रहे थे? Okay, so we are discussing a special kind of treatment, a special kind of calculation that we did not discuss in this chapter yet. And it says, if there is a non-resident who purchase shares or debentures, all conditions should be fulfilled, of an Indian company and the important condition is foreign currency. If that is not in foreign currency, then normal provision would be applicable and tax rate will also change. If these all four conditions fulfill, then the tax rate would also different and the calculation method is completely different. So now if all condition has been fulfilled, then the provision says at the time of transfer, the capital gain would also need to be calculated in foreign currency. We will not calculate this capital gain in Indian currency. If you purchase that, listen carefully, whether at the time of transfer, we receive the Indian currency, still we calculate the capital gain in foreign currency if at the time of purchase, it has been purchased by use of foreign currency. Understood? Now for the purpose of calculation, again, there is no assessee problem in this kind of question. Assessee would be, of course, the normal case. For the purpose of capital gain, what we need? Assessment year. That would be easy. Then assessee, who will transfer would be the assessee. Then period of holding, not an issue. The date of purchase and the date of transfer would create the period of holding that would decide it a long term or short term. Okay? Even if it's long term, no indexation benefit. Whether it before July, etc., does not matter. If foreign currency calculation provision applicable, then indexation benefit abolished. Now the fourth case, what should be the sale consideration? That would be given in question in rupees. That would be given in Indian rupees. Like suppose in the Indian rupees it has been given that the consideration was 16 lakh rupees. Fine. So we need to convert this 16 lakh rupees into the foreign currency. Suppose we have purchased these debenture or shares using dollars. So we need to convert these rupees value into dollars. So the sale consideration should be in dollars. We have to write it down for the purpose of calculation of capital gain. Fine. So now how we convert this INR value into dollars? By the help of rate of exchange or exchange rate. And that would be given in question. Fine. So by the help of those exchange rate, we need to convert this 16 lakh rupees into the dollars. So that would be my sale consideration. For this purpose, in the question, at the time of transfer, the transfer date, exchange rate would be given. Sir, foreign currency means he should have trading account in foreign country. If trading account in India is he will purchase in Indian currency. B cycle run, it does not matter where is the trading account. The provision says if he utilized foreign currency for purchasing the security, then we will calculate the capital gain in foreign currency. Whether account is in India or outside India does not matter. And if the foreign currency does not utilize, then normal provision would be there. The calculation would be in only Indian rupees. So it would be specifically mentioned in the question whether foreign currency has been utilized or not. So for the purpose of our solution, for the purpose of income tax, for the purpose of our calculation, those transaction or those information is just relevant. Okay. So for the purpose of converting these INR value into the dollars, there would have been given the exchange rate on the sale date, transfer date. They will provide you TTBR and TTSR, both. TTBR stands for telegraphic transfer buying rate. TTSR is for telegraphic transfer selling rate. Fine. Buying rate and selling rate. And these rates would be given in question from the point of view of RBI. TTBR means this is the price on which RBI buy dollars or currency. And TTSR means this is the rate at which RBI will sell currency. So suppose if I am having some INR, 1 lakh INR, and I am going to RBI to convert them into the dollars. So what is that RBI will utilize, TTBR or TTSR? If I am having INR and I am going to convert them into the foreign currency to the RBI. So what is the rate RBI should utilize, TTBR or TTSR? So RBI will utilize TTBR. And if I am having dollars and I am going to convert those dollars into Indian currency, then if I'll go to the RBI, they will provide me at the rate of TTSR. So this is telegraphic transfer buying rate, and these buying rate and selling rate is from the point of view of RBI, not from the point of view of assessee. This is the buying rate at which RBI purchase security, and this is the selling rate RBI sell dollars. Fine. From the point of view of dollar, this is buying rate and this is selling rate. Buying rate will always high than the always lower than the selling rate. So that would be given in question. Suppose in the question it has been given that at that time both rate would be there, BR and CR. Suppose this is 79 and this is 81 at the time of transfer. So that means RBI buy $1 for 79 rupees. And if you want to buy dollars from RBI, they will charge 81 rupees against $1. So of course, sale always be higher than purchase. So the same concept has been applicable over here. Fine. So now we need to convert this 1,60,000 into the Indian currency with the help of these rate. So which rate we should use? 79 or 81 to convert 1,60,000 into Indian currency? Bhavna is saying 79, Hardik is saying 79, Manvi is saying, Jinki is saying 81. Okay, 79 के ज्यादा वोट आए, 79 और 81। एक आंसर हो सकता है, दोनों में से कुछ भी नहीं, ना 79 na 81. When you have two choices, you are giving the answer, there could be another answer, and the correct answer is not 79, not 81. No, we need to take the average rate. To convert this, your concept is correct. Buying rate, according to buying rate, you are saying this, but the rate which need to be used for the conversion that has been given in the provision, that we need to take the average of TTBR and TTSR. So 79 plus 81 average is divided by 2. So that would be 80. So that's why I have taken this value 160, that could be easily divided by the 80 value. So 79, 81. So we need to convert it with average of TTBR and TTSR. So in the question, TTBR, TTSR would be given. You just need to find out the average of it. So average would be 80. And if you will find it out now, we need to find out the converted value. So that would be $2,000. So sale consideration would be $2,000. First, we have find it out the sale consideration. Now the same concept would be applicable in case of purchase. So suppose these securities have been purchased by using foreign currency at a time of purchase. And for that purpose, we used a certain amount of rupees expended. We utilized the foreign currency, but we converted and then we paid in the form of INR. And the question says, suppose we have purchased in 2015 and suppose the purchase rupees value was 1 lakh. So now this 1 lakh needs to be converted into again dollars as a cost of acquisition or cost of improvement. So we need now TTBR and TTSR at the date of purchase. That would also be given in the question. Suppose it has been given 49.51. So the average would be 50. So now we will have our same. We need to change it. Suppose this is, we can change this. This is 49. So TTBR is 49, TTSR is 51, and this suppose is 80,000, not 1 lakh. So now my average would be 50, and due to this average, now my value for the in the foreign currency would be $1,600. Even if it's long term, there is no indexation requirement in these provisions. So assets is long term because we have transferred in 2024, suppose May. But there is no indexation allowable in case of foreign currency convertible computation. So now the capital gain, long term capital gain would be $400. Now one last twist. The concept says capital gain has been calculated in foreign currency, but we need to pay tax in India in Indian currency. So now you, at the end, when you have calculated the long-term capital gain or short-term capital gain in the dollar format or in the foreign currency format, now you have to convert it again into INR. So to convert this $400 into INR, now this is the question I need to ask. Which rate should be used? Now the correct answer is whether it's be TTBR at the time of transfer or it should be TTSR. Only out of these two, one need to be used to convert these dollar into the rupees. So what rate should be used and what should be the INR value? Ajay Surya is saying TTBR, Neeru is saying TTSR, Nan is saying TTBR. More logic lagao, you will get the correct answer. Either we need to divide or we need to multiply. We need to multiply, correct? Which rate? Whether it should be 79 or 81. What rate we need to be used for multiplication, whether it's TTBR or TTSR. You should apply the logic. Assessee is having $400. The gain is with assessee is having $400. So if I am having $400, I have to convert it from RBI into the rupees. So when I'll take this $400 to the RBI, what RBI will do? They will buy or sell. They will buy dollar from me. So the TTBR rate would be applicable. So the correct answer would be 400 into 79. जो भी आता है कितना हो गया? That would be 31,600 rupees. So TTBR at the time of transfer need to be used to calculate that gain into the Indian currency. Okay, well done. ये कौन सा एवरेज निकाला गई थी बच्चे ने? Somebody is saying 66. 81 plus 51 divided by 2. Who is this? Nitin, what are you doing? Chalo. So back to the question now. We have an example also over there, and the concept and the provisions are also there to discuss. In case of non-resident, capital gain from the transfer of shares or debenture in an Indian company shall be computed in foreign currency. Initially utilized for the purchase of such shares or debenture, following rates we need to be used. For the purpose of cost of acquisition, average of TTVR, TTSR at the date of acquisition, of course. For sale consideration and expenses on transfer, average of TTBR and TTSR at the time of transfer. Capital gain in foreign currency is to be converted by TTBR at the date of transfer. No indexation will be done in case of shares or debenture of Indian company if it is purchased in foreign currency. The full form of TTBR specified over here, telegraphic transfer buying rate. So it is technically the rate from the point of view of RBI. Now the question says NRI remit $40,000 in India on 16/9/2020. The amount used partly in purchasing security in India on 3rd October 20 for 10,000 share at the rate of 12 each. These shares are sold on 30th March 25 at the rate 36. So on 16th September 20 TTBR TTS are given, but this is the date on which the amount has been remitted. The foreign currency has been remitted. So this is not for any use. We need the purchase date TTBR TTSR and the transfer date. On 3rd October, the TTBR TTSR was 1921. On sale date, it's 4446. We need to calculate the capital gain. So sale consideration is 3,60,000. As per average of TTBR TTSR, it would be $8,000. Its less cost of acquisition would be $6,000. Profit would be $2,000 multiplied by TTBR of transfer date rate. So my capital gain would be 88,000 rupees. The tax concept has been discussed over here. This we are going to discuss in again chapter or part 2 of capital gain also. On long-term capital gain arising from transfer of unlisted security or shares of a company in which public are not substantially interested. Non-resident and foreign companies are subject to tax at a concessional rate of 10% without indexation benefit or currency conversion. If such transfer take place before 23rd of July, and 12.5% without indexation or currency conversion if such transfer take place on or after 23rd July 2024. So this provision does not talk about the taxability on this value. Why? You might be feeling that this provision is talking about the taxability of this above provision, but technically it is not. If you read carefully, there is a difference between this concept and whatever we have discussed above. So this discussion is regarding those Indian company share debenture which has been purchased in foreign currency. Its tax rate is completely different. That we will discuss in part 2. And for this note has been stated for those Indian company shares and debenture purchased by non-resident, but not in foreign currency. So these are for those shares those have been purchased in Indian currency. So we will discuss these provision in detail in part 2. So please do not get confused that this part is talking about the taxability of this concept. No, this is a separate provision and this is different. Everything is similar, but the foreign currency, if utilized, the tax rate would be different. If foreign currency does not utilize, the tax rate would be completely different. What are the tax implications that we will discuss from day after tomorrow, of course. Now, the second last concept of this part 1, that is no more exemption for the capital gain arising from listed equity share. Technically, the long-term capital gain from listed equity share was earlier exempted from capital gain. I guess till 2018 or before 2018, it was exempted. But that exemption section 1038 has been abolished. We do not need to remember this, of course, not required. But you must remember, in the case of cost of acquisition diagram, what we have discussed in the last class, or I guess 2 or 3 classes before. In case of cost of acquisition, you must remember there was specific note which we have written over here. That a special provision for cost of acquisition for long-term equity shares, equity-oriented fund, bonus share acquired a lot before 1st February 2018 and on which STT has been paid. So this concept is now going to be discussed. I have written over here that we will discuss in detail in page number 44. So certain condition must be fulfilled. That is for equity share, long-term, equity-oriented fund, bonus share. Those have been acquired before 1st February 2018. If it is acquired on or after 1st February 2018, then for these bonus share, etc., this concept will be applicable. But if these bonus shares or equity shares has been purchased before 1st February 2018, then the cost calculation provisions is something different that we are going to discuss now. So you can remember that this is from cost of acquisition chart presentation. What we have left over there, the time to discuss is here from chart. So if you think from where this concept of cost of acquisition now came, because we have to discuss all the cost of acquisition concept in that diagram. So I'm just trying to reconnect you with that has been specifically mentioned in the chart. And now we are going to discuss that provision over here. The tax rates, of course, we will discuss later, but it has been stated over here that section 112A is here. Long-term capital gains arising from transfer of equity shares or a unit of an equity-oriented fund or a unit of business trust shall be taxed at the rate of 10% or 12.5%. Before 23rd of July, it would tax 10%. On or after 23rd of July, the rate is 12.5%. Do not bother about it. because we will discuss all the tax implication in part 2 of capital gain. Okay. The tax on capital gains shall be levied in excess of 1.25 lakh rupees. So here is an exemption of 1.25 lakh rupees. Up to 1,25,000 rupees long-term capital gain under section 112A will be exempted. Suppose there is a gain of 1,40,000, then only 15,000 is going to be taxable. The concessional rate of 10 or 12% will be applicable if STT has been paid. So that is not required. We just need to find it out how cost of acquisition and capital gain need to be calculated in case of long-term capital asset. Those have been purchased up to 1st February 2018. So you can see it has been written that the tax rates, details and benefits would be discussed under capital gain part 2 notes. So the rate is 10% to 12.5%, but there is no indexation benefit in either case. That is also has been mentioned. So this is the full concept which has been written over here. And I am going to teach you all this thing with a very simple diagram presentation. This is everything has been written over here. This analysis, everything has been explained over here. So these provisions are applicable on equity shares if STT on purchase and on transfer both paid. So those equity share on which STT has been paid at the time of purchase as well as on the time of sale, or equity oriented fund STT being paid on transfer only. So if these shares are long term, then these provision would be applicable. If these shares are short-term capital asset, then they will fall under section 111A and tax at the rate of 15% or 20%. So this specific cost of acquisition, etc. provision would be applicable if these are equity shares, if STT has been purchased, paid on purchase and transfer both, equity-oriented fund, STT has been paid on transfer. So if these are long-term capital asset, then transfer up to 31st March was exempted. So these are not relevant for the purpose of our examination. It is a earlier provision. So now the provision is this. So if you on or after 1st April 2018, under section 112, these are going to be taxable at the rate of 10% or 12.5%, depend upon the date of transfer. Calculate the long-term capital gain without indexation benefit. We cannot take the indexation benefit, and we have the exemption of 1,25,000 exemption over here. So the provision says if shares have been purchased, whether it's bonus shares, normal share, whatever shares are they, if purchased before 1st February 2018, this date need to be kept in mind always. So if these have been purchased before 1st February 2018, then how cost need to be calculated? So cost of acquisition calculation is different. So that's why cost of acquisition provision we are discussing over here. So how we need to calculate the cost of acquisition? So provision says you have to find out the actual purchase price that would be given in question. And this actual purchase price need to be compared with the lower of these two values. Actual purchase price need to be compared with the lower of these two values, that is fair market value on 31st January 18, that would be given in question, or the sale consideration. So out of these two values, the lower value need to be taken outside. Understand? Suppose the FMV is 10 lakh, the sale consideration is 9 lakh. So we will take 9 lakh over here. And now suppose the purchase is 11 lakh rupees. So now this purchase price or the lower value need to be compared, and whichever is higher would be your cost of acquisition. So step 1 we can say the purchase price we need to take. The step 2, the lower of FMV or sale consideration need to be find out, and the higher of these two would be your cost of acquisition. if these shares have been purchased on or after 1st February 2018, then there is no issue. The purchase price would be your cost of acquisition. So if equity shares or equity oriented fund, etc., has been transferred and if it has been purchased before 1st February 2018, then to calculate the cost of acquisition, we have to follow this method. We have multiple question also. Solve question for you. You can see here there are scenarios. Like suppose sale consideration is 10 lakh. Date of sale is, of course, your previous year, 1st April 25. Actual cost is 8 lakh. Date of purchase is, you can see, before 1st February 2018. The quoted price on stock exchange, the FMV on 31st January 2018 has been given in question. So now we need to find out what should be the cost of acquisition. So the provision says the sale consideration and the FMV need to be compared and the lower of them. So that's 10 lakh or 850. Lower is 850. This need to be compared with the actual purchase price and higher would be your cost of acquisition. So in first case, the cost of acquisition would be considered 850. In the same way, the second example, date of sale is 1/4. The date of purchase need to be checked every time. So again, the same concept will be applicable. Sale consideration or FMV, whichever is lower. Lower is 750. Now this lower need to be compared with purchase price and we need to take the higher. So in this case, 8 lakh would be my cost of acquisition. After this scenario, we will take a break. Okay. Now the scenario 3. What should be the cost of acquisition? Chalo batao. In case of scenario 3, what should be the cost of acquisition? This concept comes under two sections. The cost provision is under cost concept, section 48, 49, and the taxability under section 112A. So we are discussing both things, that how to calculate the capital gain and tax liability and how to find the cost of acquisition together. So if you can see in the cost of acquisition format, the cost of acquisition after the cost of acquisition chart, there has been table has been in the notes also. So in that table also this cost concept has been included. B size saying that in case of TTBR, if there is loss, even if there is loss, the TTBR need to be multiplied. Okay, so in case of third scenario, cost would be, let's see how much should be. So this 10 lakh and 9 lakh, whichever is lower. So lower is 9 and 9 and 8, higher is 9. Correct. 9 lakh would be the cost of acquisition. In the fourth scenario, the cost of acquisition would be 10 lakh or 11 lakh. So the lower is 10 and 10 and 8, higher is 10 lakh. What would be the cost in last scenario? Fifth scenario, what should be the cost in fifth scenario? Manvi is saying 10, Veda is saying 10. In fifth scenario, the cost would be 8 lakh students because it is after 1st February 2018. That's why I stop marking from here, that I know you will do mistake. So this is the case. The purchase date is after 1st February. So if it is after 1st February, then there is no section applicability. Normal cost provision would be applicable. That would be my cost. Clear? You can see the deemed cost acquisition. Same. And now we can find the capital gain. The sale consideration less cost. E is equal to D minus A. So this is A and my cost is D. So the capital gain would be 1 to 50. This is 2 lakh. This is 1 lakh and this is 2 lakh rupees. Up to 1,25,000 is exemption here. So now exemption is 125. So remaining capital gain taxability would be 25,000. In this case, 75,000. This was 1 lakh. So full gain would be exempted. No taxability. In this case, that would be 75,000. So this we have discussed the whole scenario with the help of example and question also. These tax calculation need to be ignored because we will discuss all these tax calculation provision in part 2 of our capital gain. So that was the second last section of part 1 that we just discussed. We are now having the last 3 section is as a last part of this topic, that is section 50C, 50CA and 50D. And that we will take after a short break, of course. So Mr. Mansukh, can we take a short break of 10 minutes? Okay. Welcome back, everyone. So good to see you again. Not technically. Okay. By secret is saying the capital gain, the last date of sale is 1/4/45. Yes, that could be even that date. Does not matter. We're just trying to explain how to calculate the cost of acquisition. So in this case, even if it's 1/4/25 or 1/4/24, the answer would remain the same. If you want, you can change it to 1/4/2024 also. There would not be any fact on it. Because you were concerning about the date should be on or after 31st, 1st February 2018. So moving on to the provisions. Any other query? Okay. So now this is a small story time for all of you. So story would be in Hindi as usual. So बड़ी इंटरेस्टिंग सी एक स्टोरी है, छोटी सी. तो एक पर्सन था, एक गांव में एक इंसान रहता था और उसके पास एक हॉर्स था, एक घोड़ा. बहुत ही दुबला था, बहुत ही वीक था वो घोड़ा. और सब उसको बोलते थे कि बेकार है घोड़ा, इसको बेच दो, ये किसी काम का नहीं है, एटसेट्रा एटसेट्रा. और वो जो किसान था, वो जो पर्सन था, वो लोगों की बातों को सुनता था, उनसे अफेक्टेड भी होता था. उसको लगता था कि मैं इसे छोड़ देता हूँ, ये किसी काम का नहीं है हॉर्स. लेकिन ही वॉज अटैच, तो वो उसको कहता था नहीं, मैं इससे अटैच्ड हूँ, तो मैं इस घोड़े को नहीं छोड़ूंगा. वो घोड़ा भी सब सुनता रहता था कि सब लोग उसकी बुराई करते रहते हैं, सब बोलते हैं बेकार है, इससे तो अच्छा नहीं होता तो अच्छा रहता है इसकी वजह से. और इसको, इसकी वीक इतना है, इतना बीमार रहता है, तो उसके इलाज पे भी उस किसान को बहुत पैसा खर्च करना पड़ता था. तो टाइम ऐसे चलता रहा चलता रहा. एक दिन वो किसान जंगल से जा रहा था अपने घोड़े के साथ, और रास्ते में एक बहुत बड़ा सा गड्ढा था, एक बैल था. और वो बैल नजर नहीं आया किसान को, और घोड़ा उस बैल में जाकर गिर गया. तो घोड़ा नीचे जाके गिरा तो वो काफी अंधेरी जगह थी, वहां लाइट नहीं थी, देयर वाज ऑल डार्क ओवर देयर. एंड घोड़ा जब नीचे गिरा तो उसके फेस पे चोट लगी, एंड ही वाज नॉट एबल टू ओपन हिज माउथ, सो ही कैन नॉट सेंड सिग्नल दैट आई एम फाइन. वो बोल ही नहीं पा रहा था, कुछ भी आवाज नहीं निकल रही थी. तो किसान ने नीचे आवाज लगाई, किसान ने पूछा कि आर यू ओके, एटसेट्रा एटसेट्रा. देन उसकी कोई आवाज नहीं आई. फिर गांव से उसने और लोग बुलाए, उसने बोला ऐसा है, मेरा घोड़ा नीचे गिर गया है एंड आवाज नहीं दे रहा. सब लोगों ने कोशिश करी, थोड़ा टाइप ट्राई किया, एंड देन उन्होंने कहा कि अच्छा है, अब माइट बी ही इज नॉट एनी मोर, ही इज डेड, सो लीव हिम, उसको यहीं पर छोड़ देते हैं. तो बिकॉज कोई रिस्पॉन्ड नहीं आ रहा, बट घोड़ा वॉज लिसनिंग एवरीथिंग, नीचे सब सुन रहा था. सो काफी अजीब लग रहा था कि सब लोग ये कह रहे थे कि लीव हिम, नाउ ही इज डेड. तो किसान को भी काफी देर इंतजार के बाद लगा कि फाइन यही सही है. तो फिर सब लोगों ने डिसाइड करा कि इस जो बड़ा सा बैल है कोई और ना गिरे, इसको मिट्टी से बंद कर देते हैं. तो सब लोगों ने उसमें डस्ट और मिट्टी डालना शुरू करा. अब नीचे जो घोड़ा था उसने देखा उस बड़ी सी जगह जहां वो नीचे गिरा था अंधेरे में, वहां पर एक बैग था. उस बैग में बहुत सारे ज्वेलरीज, गोल्ड एटसेट्रा थे. तो उसको लगा कि अगर मेरे मालिक को ये गोल्ड मिल जाए तो ही विल बी वेरी रिच एंड विल बी वेरी हैप्पी. तो उसने वो गोल्ड उठाया. लेकिन बिकॉज वो ऊपर ये सिग्नल नहीं दे सकता था कि आई एम फाइन, तो कोई उसे बाहर निकाल पाता. तो ही वॉज वेटिंग. एंड हुआ क्या, ऊपर से जब जितने भी लोग थे उन्होंने जब उस वेल में मिट्टी डालना शुरू करा, तो जैसे जैसे मिट्टी उसके ऊपर गिरती थी वो उसको साफ करता था, और फिर जब मिट्टी जमीन में गिरती थी उसके ऊपर खड़ा हो जाता था. फिर और मिट्टी आई, फिर और मिट्टी, जैसे जैसे डस्ट उसके ऊपर गिरती जाती थी वो उसको साफ करके उसके ऊपर चढ़ता जाता था. ऐसे कर कर कर, स्टेप बाय स्टेप, एक टाइम हुआ जब वो उस वेल से बाहर आया विद दैट बैग जिसमें बहुत सारे ज्वेलरी, कॉइन्स, प्रेशियस मेटल, गोल्ड एटसेट्रा. उसे देखकर उसका जो ओनर था वो बहुत खुश हुआ, और ये भी देखा कि उसके लिए वो कितना सारा पैसा लेकर आया. सो इन योर रियल लाइफ ऑल्सो माइट बी ड्यूरिंग दिस जर्नी ऑफ बिकमिंग अ सीए, मे भी बहुत सारे लोग आपके बारे में आप पे डाउट करेंगे, आपसे बोलेंगे ये नहीं हो सकता, आप नहीं कर पाओगे सीए, आप पढ़ाई नहीं कर पाओगे, एटसेट्रा एटसेट्रा. तो लोग आपके ऊपर बहुत सारे ब्लेम्स, डाउट्स एटसेट्रा देंगे. बट यू हैव टू बी वेरी स्ट्रांग एंड यू हैव टू बी कॉन्फिडेंट अबाउट योर सेल्फ दैट द टाइम विल कम एंड आई विल प्रूव दैट हाउ वर्दी आई एम. तो जब भी लोग आपको बोलेंगे आप नहीं कर पाओगे, आपसे नहीं होगा, जस्ट इग्नोर देम एंड डू व्हाट यू कैन डू, and just do your hard work, and one day will come that everyone जो आप लोगों पर ट्रस्ट नहीं करते हैं, जो आप पर डाउट करते हैं, they will realize that they were wrong. So just believe in yourself, like that horse, never give up. And the day will come, that one day will come, that one day. So after day one, day two, day three, there would be a one day and it would be there in your future. So be strong and always be positive and confident. Okay, now moving on to the last provision of this part one of capital gain. And I believe you must have gone through with this provision PGBP also. Under PGBP, there was a concept of, I guess, section 43CA that discuss about the full value of consideration in certain cases in which stock and trade has been transferred. So exactly the same copy paste provision has been made in capital gain. So the section 50C, 50CA and 50D discuss about only one provision, and that is the sale consideration, the full value of consideration for computing capital gain. Section 50C is for immovable properties. So under capital gain, if there is any immovable property transfer, then how to find the sale consideration need to be discussed under section 50C. The 50CA is for unlisted shares, sales consideration, how to calculate or find the sale consideration in case of unquoted shares. And 50D is for any other case where consideration is unascertained. So if there is any case in which consideration is unascertained, then how we will find the sale consideration to calculate the capital gain? So the main section is section 50C. 50CA and 50D is just one line provision. They are very, very simple, but the 50C is very important because this sale consideration type of question has been asked in the examination also. So when there is an immovable asset in the question, we have to find out the sale consideration as per section 50C, and the concept says that if the stamp duty value, understand? Stamp duty value, that means government value or the circle value. So the stamp duty value, if exceeding 110% of consideration which has been given in question, in that case, sales consideration for the purpose of capital gain would be the stamp duty value. And if it is not so, if the stamp duty value does not exceed 110% of consideration, then the sale consideration would be the consideration given in question, this value. Suppose the stamp duty value is 20 lakh and the consideration which has been given in question is, suppose, 15 lakh. So the stamp duty value is 110%, exceeding 110% of this consideration. So for the purpose of calculation of capital gain, 20 lakh would be the sales consideration. And if suppose it is not so, in that situation, the consideration would be your technically sales consideration for the purpose of capital gain. So here are the provision, what we are going to discuss one by one. Land or building or both. So this concept is applicable on immovable property only. Section 50C says, yes. So the section 50C says, if stamp duty value exceeding 110% of the consideration received or accruing as a result of transfer, then the sale consideration would be the stamp duty value. Otherwise, the consideration would be the sales consideration. Now, one more clarification in this regard, that if the date of agreement, generally in case of immovable property transfer cases, there is registered agreement prior to the transfer deed. In this registered agreement, the consideration or the terms and condition has been decided by the buyer and the seller for purchasing that specific immovable property. Suppose there is A and B, and A and B decided to purchase a immovable property for 50 lakh rupees. Before this transaction need to be happen, the transfer deed need to be registered. Before that, they will do a registered agreement in which the buyer, Mr. B, suppose, gives some amount as advance. That I am paying you 5 lakh rupees as advance money, and within a certain time, I will arrange the rest of the amount, that is 45 lakh rupees, etc., and I will go for the registration of transfer deed. So there would be a date of registered agreement. At that time, would be some amount which need to be transferred as advance money. And there would be one more date, that is actual transfer deed or actual registry date. Now the problem arises this, that in case of section 50C, we need the stamp duty value to compare with the consideration. So there would be stamp duty value of these both days, and they could be different also. We must have the stamp duty value at the time of register agreement, and we will have one stamp duty value. It could be changed, that it would have been changed from the date of registered agreement till the date of actual registry. So suppose this agreement has been dated on 1st January 2024, but the actual registry took place on 4th May 2024. So the stamp duty value on 1st January 24 should be taken for the comparison purpose, or the stamp duty value on the 4th May 2024 must be taken for the purpose of comparison. So this provision must have been discussed in PGBP also. Exactly copy paste provisions are here. So you must have gone through with those provisions under PGBP head also. So the provision says, if at the time of registered agreement, which stamp duty value need to be taken for the purpose of comparison, the provision says, if at the time of register agreement, if advance has been paid via account pay check or via online mode, etc., then the rent agreement date stamp duty value need to be considered for the purpose of comparison. But if no advance money paid via account pay check, etc., or paid by cash, etc., then the stamp duty value at the time of transfer deed, that means the time of registry, need to be taken for the purpose of this comparison. So if date of agreement is, you can see, is different from the date of transfer, and whole or part of the consideration received by way of account pay check, bank draft, ECS, IMPS, etc., on or before the date of agreement, then the stamp duty value of date of agreement would prevail. If any amount received in account, pay, check, etc., case A will apply. That means value on the date of agreement will be considered. And if it is not, then value at the time of registry need to be taken for the purpose of section 50C. We have multiple examples also regarding this provision. Now, the second case, if the date of agreement is different, but the whole or part of the consideration has not been received by way of account pay check, then we will take the stamp duty value on the date of transfer. However, if the stamp duty value on the date of agreement or the date of transfer, as the case may be, is less than or up to 110% of the sale consideration received, then consideration would be treated as sales consideration. Here are examples. So first of all, you have to find out for section 50C. First of all, you need to check stamp duty value of date of agreement or date of registry, which need to be taken. First of all, you have to find this, which date stamp duty value need to be taken. Then the 110% concept need to be applied. So the example says, suppose there is a case where transfer of building, the actual consideration is 100 lakh. Okay. The stamp duty value on the date of agreement is 109 and the stamp duty value on the date of transfer is 112 lakh. Now, if the at the time of agreement, the payment has been received via check, etc. Then you will take the stamp duty value 109. And now you can see the stamp duty value does not exceed 110% of consideration. So if the stamp duty value of this date has been taken, then as per the provision, the sale consideration would be 100. But in the second case, if the stamp duty value has been taken on the date of transfer, it is exceeding 110% of consideration. Because consideration is 100, 110% would be 110 lakh and my stamp duty value is 112 lakh. So if it is exceeding, so now the sale consideration would be 112 lakh. The other information is explaining which should be taken. If any part of the consideration is paid by prescribed electronic mode on or before the due date of agreement, then the consideration would remain 100 lakh because 109 does not exceed 110%. If no part of the consideration is paid by prescribed electronic mode on or before the date of agreement, in that situation, the stamp duty value of 112 lakh need to be taken for comparison. And in that case, because it is exceeding 110%, so the sale consideration would be 112 lakh rupees. I hope it's clear. Yes, exactly. Larry, it is section 43CA exactly. And that talks about when you transfer immovable property as your stock in trade. So if you are having immovable property as your stock in trade in your business, and if you transfer that stock in trade, then what should be the sale consideration or sale price for that stock in trade? So we need to calculate that stock in trade sale consideration exactly in the same manner we are calculating under section 50C. So there is no difference between भावना is saying sir example clear नहीं है. Okay, we discuss करते हैं. So the provision is saying if there is an immovable property, चलो पूरा डायग्राम ही उसमें बना लेते हैं. देखो भाई, if it is an immovable property, this immovable property either will be your stock in trade or either will be your capital asset. Clear? If it is in stock in trade, that at the time of sale, the sale consideration would be decided as per section 43CA. What should be the sale value? If it is a capital asset, then the sale consideration would be decided by section 50C. And both are exactly the same. There is no difference. Just which section needs to be applicable, that is the difference. So if your immovable property is stock in trade, then the same provision will govern by section 43CA. And if your immovable property is a capital asset, then exactly the consideration provision will be governed by section 50C, but both provisions are exactly copy paste same. The head of income will be changed. If it is stock, the concept will be applicable under PGBP head. And if it is capital asset, of course, then it would be under capital gain head. But the concept and the applicability exactly same. Now, what is the provision? First of all, you have to find it out the stamp, which stamp duty value we need to take. There would be two stamp duty values given in the question at the time of agreement. At a time when a buyer pays some amount as advance and the remaining value would be paid in future at the time of registry. So we can say at the time of agreement, and we can say at the time of legal transfer of property. So at the time of agreement, there would be advance payment. At the time of transfer, there would be full payment. And legal ownership would be changed at the time of transfer. Fine. Now the provision says if at the time of agreement, any payment, any advance payment transferred via account pay, check, or any online mode, etc., IMPS, RTGS, etc. So if it happens, then this stamp duty value will be considered for section 50C provision. And if no payment at the time of agreement, if no payment transferred via online mode, etc., in that case, transfer date stamp duty value would be considered for section 50C. Over it, everything is clear. So first of all, we have to find it out which stamp duty value we need to consider for section 50C consideration provision. So now you have understood that in which value, agreement date value or transfer date stamp duty value, which value will need to be taken for the purpose of calculation. Clear? Suppose the transferred agreement date value is 109 lakh stamp duty value, and the transfer date stamp duty value is 112 lakh. Now, the actual consideration, seller say, I have received 100 lakh rupees from the buyer. Actually, I have received 100 lakh rupees from the buyer for transferring this immovable property. So now this is the actual consideration which has been claimed by the buyer and seller. And these are government values. We call that stamp duty value, etc. One stamp duty value is 109 lakh at the date of register agreement, and the date of transfer, the stamp duty value has been given 112 lakh. Now, if this value has been taken, if the condition fulfill, and if we consider stamp duty value 109 lakh, if the question says that yes, at the time of agreement, some amount has been received via electronic mode, etc. So if the question says this, that amount has been received via online check, online transfer, account pay check, etc., then we will find out the sale consideration by taking stamp duty value at the time of agreement. So what will happen now? We have to check whether stamp duty value exceed 110% of consideration. The consideration is 100 lakh. So what should be the 110% of consideration? That means 110 lakh. So does my stamp duty value exceed 110% of the consideration? The answer would be no. So if it does not exceed 110 lakh rupees, then the consideration would remain for the purpose of capital gain or for the purpose of PGBP, it will remain 100 lakh rupees. Because stamp duty value does not exceed the 110% of consideration. Now, suppose the question says that at the time of agreement, no amount received via account, paid check, or online mode, etc. In that case, now we will take the stamp duty value for the purpose of comparison is 112 lakh. So now stamp duty value does exceed 110% of consideration because 110% of consideration is 110 lakh and my stamp value is 112 lakh. So it does exceed 110% of my consideration value. So because it is exceeding, so now the sale consideration would be 112 lakh. Need to be considered for the purpose of sale consideration, whether for capital gain or PGBP. Now it is, I guess, better in a chart presentation, you are able to find out which is how to apply these provisions. So first of all, you have to find the stamp duty value of both date, at the date of transfer and at the time of agreement. Technically, in the exam, in the question, it has been already mentioned. I guess the both value must be given to make you confused. Now you have to see which case is applicable. Does at the time of agreement we have received advance via check, online mode, etc.? If yes, then we will take this value for the purpose of comparison. And if no payment has been received via account pay check and online payment, etc., then I will consider this stamp duty value for the purpose of comparison. So that would explain what should be the sale consideration in that particular case. अभी क्लियर हो गया सब कुछ, को कंफ्यूजन था? भावना क्लियर? Okay, well done. So now we will solve more example of this. First we have discussed okay, examples in different, of course, notes. Now the unquoted shares, the unlisted share. Okay, the first case we have discussed. The point number 2 says if the assessing officer refers the valuation to a valuation officer, suppose there's some dispute regarding the stamp duty value. On the assessee's claim that the stamp duty value exceed the FMV of the property on the date of transfer. One more interesting thing. Generally, it happens that my market value, fair market value, exceed stamp duty value. Generally, it happens. But suppose assessee claims that the stamp duty value exceeding fair market value. So it would be undue for the purpose of an assessee. Suppose I am holding a house and its market value is suppose 50 lakh rupees. Market value is 50 lakh rupees and I am able to sell this. The consideration is also 50 lakh. The stamp duty value suppose is 70 lakh rupees. Now, as per section 50C, if you'll try to solve this question as we discussed above, whether stamp duty value is at the time of agreement or whether this is a stamp duty value at the time of transfer. How we will find the stamp duty value or the sale consideration? Because in this case, stamp duty value is exceeding 110% of consideration. 110% of consideration would be 55 lakh rupees. So technically, if you will see, my sale consideration is 50 lakh, but my stamp duty value saying that it is exceeding 110% of sale consideration. So in this case, sale consideration would be 70 lakh rupees. As per the provision we just discussed, if you solve this question like this, then the sale consideration would be 70 lakh. What is the difference between point number 1 and 2 we are discussing? In point number 2, we are discussing with the fair market value. In point number 1, we discussed with the consideration. Now there is a genuine hardship within assessee that suppose if someone property's market value is 50 lakh only. In real, the market value is 50 lakh rupees and the stamp duty value is 70 lakh. Then as per section 50C, if you apply the provision of section 50C, assuming this FMV as a consideration, because this FMV will be the consideration. So now if as per that provision, you are going to find out the sales consideration, it would come 70 lakh rupees. Now assessee object. Assessee says my property market value is 50 lakh in real. I am getting 50 lakh rupees as consideration in real. Then how I will be able to pay tax upon 70 lakh? Or we can say, why should I pay tax upon 70 lakh rupees? In the first instance, in the first case, it was generally happen that people show the consideration less than fair market value. So if you show consideration less than the fair market value, then case number one is justified. This case is justified when you are showing consideration less than fair market value. But there could be instances, there could be genuine cases in which fair market value could be lower than stamp duty value. And if you are going to do this, if you are considering this as a sale consideration, assessee will object. And in this case, the provision says that if it has been proved, that the fair market value does not exceed the stamp duty value of the property, then the lower would be taken as sale consideration. The provision says if the assessing officer refers the valuation to a valuation officer on the assessee claim that the stamp duty value exceed the FMV on the date of the property on the date of transfer. So valuation by valuation officer stamp duty value, if valuation by valuation officer is less than stamp duty value, so that would be the value should be considered as the sale consideration. So the provision says if it happens that stamp duty value is higher than fair market value, in that case, the sale consideration would be fair market value. That means lower would be taken as sales consideration. In this example, 50 lakh would be taken as your sales consideration. So this is a very genuine case which has been framed by the department. That in normal case, we will take that 110% concept. But if in any question it has been given in the question that the fair market value is less than the stamp duty value, then the fair market value would be treated as your sales consideration. So in first case, if the valuation officer says no, it's if valuation officer value more than stamp duty value, like in this case, suppose the 75 lakh is the valuation officer value and stamp duty value was 70 lakh. In that case, consideration would be 70 lakh. And if the valuation officer value is less than stamp duty value, suppose 50 lakh has been the valuation officer value, then 50 lakh would be the sales consideration. So let me explain you with the help of diagram. So that would be really easy. भावना above केस में फेयर मार्केट वैल्यू नहीं गिवन थी, सिर्फ कंसिडरेशन गिवन था, एंड दैट कुड बी मैनिपुलेटेड. अगर अबव वाले केस में 100 लाख सेल्स कंसिडरेशन की जगह एफएमवी गिवन होती, तब वो ये वाला केस होता. तो आप सेकंड केस सिर्फ तब अप्लाई करेंगे जब एफएमवी गिवन हो, और अगर एफएमवी से ज्यादा है स्टैम्प ड्यूटी वैल्यू, तब ये वाला केस एप्लीकेबल होगा. देखो ऐसे, इफ stamp duty value exceed the FMV. So if this is the situation, then second wala case applicable ho. Suppose stamp duty value is 70 lakh and FMV is 50 lakh. So whenever this will be the case, the department will transfer this case to the valuation officer. A valuation officer is the person who will find out the real value of that property. The market value is correct or incorrect. So if valuation officer value exceed the stamp duty value, suppose you claim the FMV is 50 lakh, but the valuation officer says no, the FMV is as per valuation officer is 75 lakh suppose. So in that case, the stamp duty value would be the sale consideration. So 75 lakh not, but 70 lakh would be the sale consideration for the purpose of capital. Suppose the valuation officer says that yes, the fair market value is 50 lakh. Assessee is correct. So in that case, the valuation officer value would be taken as sale consideration, that is 50 lakh. So if valuation officer says that your stamp duty value is less than the FMV, that means you are technically saying this FMV, but that is not correct. The real FMV is higher than as you declared. So in that case, stamp duty value would become your sale consideration. And if your fair market value is less than the stamp duty value, then that fair market value would be the sale consideration for the purpose of this calculation. Remaining points are very simple. If the case has been in any dispute, if the stamp duty value case has been in any court or in any appeal, has been pending over there, then the value so revised, which has been decided by the appeal or authority, that would be treated as the sales consideration. So section 50C has three cases. First case we have discussed. If the FMV is lower than the stamp duty value, then second case would be applicable. If the stamp duty value is in any dispute, then this third provision would be applicable. In case of unquoted share, that means those are not listed, the FMV of such shares, that would be the sale consideration. In third case, any capital asset, section 50D, where the consideration received or accruing as a result of transfer of a capital asset by assessee is not ascertainable or cannot be determined. So it says if there is any case in which you cannot determine the consideration value, then the FMV of the said asset on the date of transfer would be the sale consideration. So if you are transferring any asset and the consideration you are receiving cannot be, the monetary value of that consideration cannot be determined. In that situation, the FMV of the property you are transferring on the date of transfer would be the sale consideration under section 50D. And that FMV would have been given in the question. The valuation rules in rule number 11 UA, how you will calculate the value, the fair market value of the unlisted share, that would be dealt at final level. That is not your intermediate level. Under intermediate level, the FMV of the unlisted share would be given in the question directly. That was our part 1 of capital gain. In part 2, we will be discussing the provisions of capital gain exemptions and the calculation of tax also. And we will also discuss MCQs and test your knowledge question also in part 2. Always remember, this is my best quotation to all of you. Revise twice. That's my advice to make you wise. As much as you revise your provision, you will understand those provision more clearly, and definitely then will help you in your examination also. So if there is any query, next is 50D. 50D is saying, Kasak is asking, sir, can you give example of case of 50D? SSC will know the sale consideration of the asset. What case will it be applicable? Okay, let me tell you with the help of an example. Suppose Mr. A एक बहुत अच्छे painter है. He's a very nice painter and he made a painting, a very beautiful painting. Right? Like this. This is modern art, fine. He has made this painting, and some celebrity has seen this painting on online, on Instagram, etc. Suppose Salman Khan, he saw this painting on Instagram, etc. So he contacted to Mr. A that I want to buy this painting. I really found it very interesting. So Mr. A was so overwhelmed because he's Salman Khan, he wants to buy his painting. So he said, so you can take this painting without any monetary consideration. I won't ask any monetary consideration for that painting. So in response, this is not free. Remember, listen very carefully. He's not giving it free. He's saying this is without any monetary consideration, but you have to come to my home and we will have dinner together. That is my consideration. Now, having dinner with Salman Khan would or could be having different kind of value for different person, because if you are a fan of Salman Khan, definitely it would be a very big thing for you. But if you do not like Salman Khan that much, so that might be a case in which you do not feel that this is that important. So, like watching a cricket match is very important for someone going into the stadium and watching it. So, it will depend or it will be different from the person perspective, that who is actually providing these services and who is the receiver technically. So, this thing that having a dinner with Salman Khan could have a very huge value for Mr. A, but for Mr. B, it could be not that much value, or for any other actor also. It might be, if it is Shah Rukh Khan, that might not be that big value because they are usually friends. So in that situation, this consideration is kind of a consideration that could have different kind of value for different kind of person. So we say this is kind of a consideration which is unascertained consideration, because dinner value is not important. The dinner with Salman Khan is important for Mr. A because he is a big fan of Salman Khan. So now how we will calculate the sale consideration in this case, because there is a capital asset, it has been transferred. If it has been given free, this kind of consideration also not asked by Mr. A. So the section 47 provision would be there. So there was not requirement of any kind of calculation of capital gain, but now there is a consideration. But this consideration is that consideration which could be have different value for different kind of person. So that is called unascertained consideration. Now section 50D comes into the force. And now what it say? It says, okay, we cannot find the value of this consideration because that could be different from different perspective of persons. So now what we will do, we will take the fair market value of this painting. So if Mr. is not going to sell this painting to Salman Khan, what could be the value to the any other person? Suppose this is 1 lakh rupees market value. So we will take the sale consideration equivalent to 1 lakh rupees in this case at the time of transfer. Suppose this painting has been 2 years old, but we will not take the FMV of 2 years back. Suppose at that time it was 60,000. So we are saying that we will take the FMV at the date of transfer of that asset which has been transferred against that unascertained consideration. So I hope you will remember with the help of this example what is section 50D cases are. Yes, you can say. So that was the case. If there is any other query, you can ask me. Otherwise, we are going to conclude this session. Okay, so I guess there is no more query. Badhiya example. Thank you, sir. You're welcome, of course. So, Mr. Mansukh, can we conclude the session? Yes, Hardik, we can take. Mr. Mansukh, can we conclude the session? Thank you so much.